Yes, Ritika.
So what did you say? What did you said a few times? A few minutes. Am I audible?
You're not clearly audible. You're not clearly audible. Your voice is not clearly audible.
What did you say, sir? Before few minutes, I joined the class little late. Hello.
What? I did not get your point.
So
Your audio is still not clear.
can I leave the meeting and tell you? I write it in the chat box.
Yeah, please. You're not clear. You're not audible. Clearly audible.
Okay, I'll leave the meeting, sir.
Okay. Now, yesterday, where we left, We'll be starting from there. Now, we had to discuss a concept of restatement of EPS. Now, what exactly is restatement of EPS? Please understand. Sir, if your organization, if your company has given bonus shares in the current year, or there is a splitting of share which has taken place. Splitting of share means one share is subdivided or it is split into 4 shares or 5 shares or 10 shares. That is called as splitting. Means 10 rupee one share will be split into 5 shares of 2 rupees face value. That is called as splitting. Or there can be a consolidation taking place. Consolidation means your share consolidation means, sir, small 2 rupees 5 shares will be added up together and made one share of 10 rupees face value. So consolidation, you also call it as reverse splitting. So in split, what you do, 10 rupee one share is split into 5 shares. And in consolidation, what is done? 5 shares added up together and made one share. That is called as consolidation. And fourth case is right shares are issued. Sir, if these are the situations, technically the company has to do a restatement of EPS. Company has to do a restatement of EPS. Now, please understand what exactly is restatement. Now, please, before going for restatement, please understand only in these 4 situations only restatement of EPS is done. Apart from these 4 situations, in any other case, there is no requirement of any restatement or as such. Right? Now, what is this exactly? Please understand. EPS will be restated for all the periods prior to the current period, which are given in the comparative statements, so that the EPS can be compared properly. So, sir, only for the comparison purpose, EPS is restated. Restated means I would say it is revised. Revised only for the sake of comparison. Now, why, sir? Let us take an example of bonus, right? And try to understand it with the example that I have put over here. I want everybody to please focus. Now, say, for example, a company has issued bonus shares. Okay. Now, in financial year 1920, the net profit was 5 lakhs and weighted average number of shares were 1 lakh. So technically, the basic EPS was 5 lakhs divided by 1 lakh, 5 rupees. 5 rupees was the basic EPS. Now, in the current year, that is financial year 2021, this is current year and this was say last year. Now, this is our current year. In the current year, bonus shares are issued in the ratio of 1:1. Means one share will be given as a bonus for every one share held. So can I say up to last year you had 1 lakh shares? So now you will be having total 2 lakh shares, that is 1 lakh plus 1 lakh bonus. 1 lakh existing shares plus 1 lakh bonus shares. So total 2 lakh shares you will have. Correct? Now, net profit for the current year was 6 lakh. So when we calculated the basic EPS, it amounted to 6 lakh net profit divided by 2 lakh equity shares. The answer is 3 rupees. Now, can I say as compared to the EPS of last year, current year's EPS is too less? Yes or no? Now, this is less because of underperformance or because of bonus shares coming into picture? Sir, mostly because of the bonus, right? Because number of shares are increasing. So if number of shares are increasing, technically your EPS will come down. Yes or no? So if I am an investor and if I see the comparative statement of this company and say this is the last year statement, this is current year statement, and I compare the EPS of both the years, I will make up my mind that I will not invest in this company. Reason, the EPS has declined. But is the real reason behind decline in the EPS is underperformance, that is company has not performed, or is it because of the bonus issue? Sir, it is because of purely because of the bonus issue. As I can see, even the net profit has increased. As per my example, the net profit has increased as compared to the last year. So what I'm writing, EPS of 2021 is comparatively lower than financial year 1920 because of bonus issue. Because of bonus issue. So what we have to do is, sir, we just have to restate the EPS of last year. We have to just restate the EPS of last year by assuming that bonus was also given in the last year. So we will consider as if the bonus was also given in the last year. So just for the sake of comparison, restatements are done. So therefore, restate the EPS of financial year 1920, considering the bonus was issued in that year only for the comparison purpose. So technically, you should not go in the last year's financial statement and change the figure of EPS. No, you will just show the restated EPS in the comparative financial statements. Right? You will not go back and change the financial statements. Huh? Your financial statements are already filed with the ROC and income tax department. So you need not go back and make any change. You will just make the necessary changes in the comparative financial statements that you are providing. So how you will restate? Sir, it is very simple. Last year's profit, restated EPS of 1920, 5 lakh is profit. But the only thing is, sir, please consider shares including the bonus. So the total number of shares will be how much? 2 lakhs. So my restated EPS will be 2 rupees 50 paisa. Now you compare 2 rupees 50 paisa with 3 rupees. Is the company underperforming now? Sir, no. So what we did? Here bonus is there. So we also showed the restated EPS including the bonus element. So now the EPS can be clearly compared. So this is the reason why restatement is done, for showing comparisons of the EPS. I hope you are understanding the point. Right? So I think you have to note this point, right? Have you noted this? Yesterday, I think you people took a screenshot and you were about to write this point. One lakh shares are bonus, and what about 1 lakh? Are 1 lakh are existing shares and 1 lakh is bonus on that now. So please apply your common sense. Total 2 lakh shares will be there now. So when you restate the EPS of last year, you will consider the 1 lakh shares plus bonus also you will consider. So total 2 lakh shares will come now. Right? Please note down. Yes, Aditya.
Hello, sir. Instead of assuming that no bonus shares were issued in the previous year, is it not better to, instead of assuming bonus shares were issued in the previous year, is it not better to assume no bonus shares were issued in the current year so that the EPS will be higher?
Wrong, because you have those shares issued and in your share capital you can see it. So how can you assume that bonus is not issued?
Yeah, because it's in we have 2 lakh shares, so we have to take the base as 2 lakh.
Exactly.
Got it.
And one more point I just wanted to add up over here for everybody. Sir, if you read the statement, what it is given, EPS will be restated for all the periods prior to the current period, which are given in the comparative. So in the comparative statement, if current year plus last 4 years are given, so technically for last all the 4 years, EPS has to be restated. Means in the last all the 4 years that you presented, in all 4 years, in all those 4 years, you have to show the EPS restated calculated by considering the bonus issue. Not only the last year, but all the years that you are presenting in a comparative statement. So generally a company makes either 3 years comparative or 5 years comparative. That is current year plus 2 years or current year plus 4 years. So 1 plus 2 or 1 plus 4. So in all the prior periods, you have to show the restatement of EPS by considering as if bonus was given in those years also. Right? Now, whatever I have written now is the actual reason behind doing restatements. Means comparison is a primary reason, but one more reason is what, sir, if I'll ask you a simple question. When I issue bonus shares, is the company generating any new funds? No, it is free of cost. If shares are split, means if one share is split into 10 shares, is company earning any funds? No. Sir, if shares are consolidated, means 5 shares are consolidated together to make one share, is company generating funds? No. In right issue, company generate funds, but lesser as compared to the fair market value. Because you might be aware that right issues are always given at a lower price as compared to the market price. Means if the market price is 100 rupees per share, the rights are given at 60 or 70 rupees only. So technically, in the rights also, there is some bonus element. Bonus element as in rights are given at a cheaper price as compared to the market price. So, sir, for all these situations, I can say that no new funds are generated by the company. Now, please understand, if new funds are not generated, can I say if funds are not generated means you cannot increase your investments in the business? And if you cannot increase your investments in the business, technically the increase of profitability chances reduces, because more you invest in the business, higher is the chances of profitability. Correct? So since here no new funds are generated, technically you cannot invest more in the business, and technically because of these reasons your profitabilities cannot increase, and rather because of increase in the number of shares your EPS falls down. So for comparative purpose, this is not correct. So that is the only reason why the EPS of previous periods are restated, so that a fair comparison can be done. This is the major reason behind doing restatement. Please note it down fast. Now the second situation where again your restatement is to be done is with respect to share split. Sir, it will have the same treatment as what we did for bonus. Same to same treatment. Let us try and understand with this example. I can see an example on your screen. Sir, financial year 1920, this is last year, and financial year 2020 is the current running year. Correct? And financial year 1920, my net profit was 6 lakh, and we had total 50,000 shares outstanding. So my basic EPS calculated at 6 lakhs divided by 50,000, 12 rupees. Correct? In the current year, financial year 2021, shares are split in the ratio of 5:1. Now, shares are split in the ratio of 5:1 means one share is split into 5 shares. One share is split into 5 shares. So technically now our revised weighted average number of equity shares will be 50,000 will be split into 5 shares. So we will have total 2,50,000 shares. Correct? I hope people are getting this. Right? 2,50,000 shares. That is, one share is split into 5. So 50,000 are split into 5 shares. So we'll have 2,50,000 shares. The net profit given in the question is 7,50,000. So when I calculated my basic EPS, 7,50,000 profit divided by 2,50,000 shares, my EPS is only 3 rupees. Now, will there be a fair comparison if I compare 3 rupees with 12 rupees? No, because here my number of shares have increased because of the share split. It is not that I have done wrong or I have done underperformance. No, it is purely because of what? The share splitting. So what we will do, we have to restate the EPS of 1920 for comparison purpose by considering as if the split took place in 1920 also. So what I'm saying, EPS of financial year 1920 has to be restated because of share split done in financial year 2021. So therefore, restated EPS will be what? Sir, profit will be same 6 lakh of last year, but divided by 2.5 lakh shares. That is number of shares after splitting. So EPS is now 2 rupees 40 paisa. Now can I say there will be a fair comparison between 3 and 2.4? Right? So this will be the situation if it is a share split. And this is the same way in which you are going to present your solutions in exam, if a question is raised on this topic. Correct? So please note down the second point. Please note down the second point. Completed point number 2. Many people from your batch attended the morning session only. Now go for the third part, that is for share consolidation. Share consolidation is nothing but it is called as reverse splitting. Reverse splitting means your 5 equity shares will be consolidated together to make one share. Means, for example, if a company is having share of face value 2 rupees. So what company decided? 5 shares we will merge of 2 rupees and make one share of 10 rupees. That is called as consolidation. So, sir, if consolidation takes place, now it will be opposite situation. Opposite situation means what? Your number of shares will reduce. So, if number of shares will reduce means the EPS of current year is going to shoot up. Right? So, people will say, sir, it is better my EPS is shooting up, why to restate? But again, sir, it will not be a fair mean of comparison because your EPS of current year will unnecessarily shoot up only because of the consolidations. So, a fair comparison has to be done. And that is the only reason why we will be doing a restatement. Now, please understand what it is exactly. Share consolidation, financial year 1920 last year. Considering net profit is 8 lakh rupees, weighted average shares are 1 lakh. So basic EPS is 8 lakh divided by 1 lakh, 8 rupees basic EPS of last year. Financial year 2021, the current year. Correct? Consolidation of shares are done in the ratio of 1:4. Means one share will be given for every 4 held. That is, 4 shares will be consolidated to 1 share only. So therefore, your revised number of shares will be how much? 1 lakh shares into 1/4 means now you will be having only 25,000 equity shares. That is after consolidations. Correct? Assuming the current year's net profit is only 6.5 lakh, it has fallen down. No problem, sir. It can come down. No problem. Right? Because in earlier 2 examples, I showed higher net profit. But in this example, I am showing a lower net profit. But it is not a cause of concern for us. Now, what will be the revised, what will be the basic EPS? So we will say 6,50,000 profit divided by only 25,000 shares after the consolidation. So 26 rupees is my EPS. So technically, when you compare 8 rupees and 26 rupees, can I say it is not fair? even after having a lesser net profit as compared to last year, you are having a higher EPS. And this is only because of consolidation of shares. So what you have to do is EPS of 1920 should be restated because of share consolidation done in 2021. So you have to show that as if the consolidation took place in the last year also. So therefore, restated EPS will be what? 8 lakh net profit divided by 25,000 shares after consolidation. Now the EPS is 32. Now you compare this 32 with 26. Now you will come to know about your actual performance. Now you can see the EPS has comparatively fallen down as compared to last year. So when you do this restatement now, then I can say it is a fair mean to compare. Now you can compare. Now whatever this 26 and 32 EPS you are comparing, that is purely with respect to the performance of the company. But if you don't do the restatement, then what will happen, you cannot actually ascertain the proper performance of the company. The EPS will either be understated or overstated because of any of these factors. So what we do is we show the bonus or the splitting or reverse splitting factors in the past years also, so that it becomes a fair mode of comparison. Correct? Please note down the third point also. Please copy down the third point. We completed point number 3. Now we'll go for some questions. We'll solve some questions, and then we'll come for the what is Sujit asking from the last example by comparing restated EPS of 2 years. What conclusion can be made about company's current position? What conclusion you want to make, sir? So that is your personal opinion. As an investor, if you want to make a conclusion, make your conclusions. Please be specific, sir. Conclusion as in what? What are you asking? Are you asking me or are you telling me? That I'm not able to understand. And here we are not to make any comment on the financial position of any company. We are just learning how to calculate the EPS or how to do the restatements of EPS. If you want to draw up the conclusion of any company, sir, you have to study the financial statements of that company to make your own conclusions. Here we are just here to calculate the restated EPS. By doing a restatement, now there is a fair basis of comparison between the 2 financial years with respect to the EPS. Now, we'll be solving some questions now. Question number 1 and question number 2. We'll be doing these 2 questions. And question number 8, sir, we have already done this. This is nothing but in the following list of shares issued for the purpose of calculated of weighted average number of shares, from which date the weight is to be considered. If you remember the yesterday's table on page number 110, 11 and 112, you will get the answer of all these 7 points from the table. And only one more point, also define potential equity share. Sir, potential equity share I'll be teaching you with diluted EPS. So when we start diluted EPS, the first thing we'll discuss is potential equity shares. So in this question, you will get all your answers from table number 111 and 112, or sorry, page number 111 and 112, the table given. And definition, there is already covered in my notes. Now what am I doing is, I am uploading certain notes in the chat box. People, please, just a minute. Don't send any message. Now, AS20 soft copy I am uploading. AS12 also I am uploading. AS10 also I am uploading. And somebody wanted AS4, that also I am uploading. So I've uploaded the soft copies of 4 chapters. So people, those are having laptops, please download these and send it in your respective WhatsApp or Telegram group so that everybody will get these files. Right? So please do it immediately. Now we will be doing question number 1. Question number 1. Now it says calculate weighted average number of shares. So don't expect this question in exam. Such questions will not come for 5 marks. It is very simple. And I think we have already solved an example like this. What it says, 1st January balance at the beginning of the year. So sir, if 1st January is beginning of the year, means technically this is a calendar year, January to December. So they have opening 1800 shares from 1st January. So they will be obviously outstanding for full 12 months. 31st May issue of shares for cash 600. So can I say 31st May issue means technically they are available from June to December. And June to December is a time period of 7 months, not 6 months. July to December is 6 months, June to December is 7 months. So they are available for 7 months. And there is a buyback taking place on 1st November. So buybacks will be subtracted for the period they are not available. So for November and December, 2 months period they are not available, correct? So we have to subtract them for the period of 2 months. So let us quickly solve this question. Let us quickly solve this question. Calculation of weighted average number of equity shares wins. So first we have 1800 shares available for the period of full 12 months. So they will be considered as full 1800 shares plus 600 fresh shares, but they are available only for a period of 7 months. That will be 350 shares added minus 300 shares bought back, and they were not available for a period of 2 upon 12 months. 2 months they were not available. So 50 will be subtracted. So your weighted average number of shares are equal to 2100. So coincidentally, weighted average shares and actual number of shares are same. Done. We'll go for question number 2. They say net profit for the year 31st March 2016 was 18 lakhs and net profit for the year 31st March 2017 was 60 lakhs. Number of equity shares outstanding until 31st March 2016, that is outstanding up to until last year, were 20 lakh equity shares, and bonus issue 1st October 2016 was 2 equity shares for each equity share outstanding as on 31st March. Means we are giving 2 bonus shares for 1 share held in the company. Sir, means for 20 lakh shares, 40 lakh will be given as bonus. That is twice. Right? So technically for the year ended 31st March 2017, you will have 20 lakh shares which are already issued plus 40 lakh bonus shares. So total 60 lakh shares. Right? And note, there is not even requirement of doing weighted average for bonus, because even if the bonus is issued on 1st October, they will be considered as outstanding for the full year. Right? So technically, entire 60 lakh shares will be remaining outstanding for the full year only. calculate the basic EPS and adjusted EPS. Adjusted EPS is nothing but your restated EPS. It is one and the same. Adjusted EPS is nothing but restated EPS. Both are same. So don't get confused in exam. Adjusted EPS or restated EPS both conclude with the same meaning. Right? So we have to do a 3-step over here. First, we have to calculate the basic EPS for 2016. Then we will calculate the basic EPS for 2017. And then we will calculate the adjusted EPS for only 2016 because 2017 will be considered as the current year. Right? So let us move for the question. First, basic EPS for 31st March 2016. So what is my net profit? Sir, it is given at 18 lakh rupees. And number of shares outstanding for the year are given as 20 lakhs. That is your gains, WNES. So therefore, basic EPS will be 18 lakh net profit upon 20 lakh equity shares, 0.90. 0.90. I will go for basic EPS for 31st March 2017. Right? So let us start. Sir, net profit for this year is given at rupees 60 lakhs. Correct? Bonus shares is equal to 20 lakh into 2. So, sir, 40 lakh bonus shares. Correct? So, therefore, total number of shares will be the existing 20 lakh shares plus 40 lakh have been added up because of the bonus. So, total we have 60 lakh shares. And since it is bonus, no need to do weighted average because any of bonus is also considered to be outstanding for the full year. Correct? So therefore, the basic EPS will be 60 lakhs net profit divided by 60 lakh number of shares. The answer is rupee 1. So we have covered 2 parts of the question. Right, so I'll just write a statement. Since bonus shares are issued in 2016-17, the EPS for 15-16, that is as on 31st March 2016, will be restated. So therefore, restated EPS for 31st March 2016 will be equal to, sir, profit will remain same at 18 lakh only, but how many number of shares we will consider? So we will consider full 60 lakh. That is as if bonus was given in the last year only. So divide by 60 lakh. So now you get an EPS of 30 paisa. Now you compare 30 paisa with 1 rupee. It is a fair comparison now. What is there in 31st March 2017? Net profit is 60 lakhs. Total number of shares are also 60 lakhs. That is 20 lakhs are the existing shares. And on those 20 lakhs, you have 2 shares issued as bonus. So total 40 lakh are bonus shares. So total you will have 60 lakh shares. So EPS will be what? 60 lakh profit divided by 60 lakh number of shares. EPS is 1 rupee. Right? So whenever you are doing a restatement of EPS, only the restated EPS will be compared with the current year. Right? Never compare the current year's EPS with the last year's EPS. Compare current year's EPS with the restated EPS of last year. Always do that. Right? Because comparing 1 rupee with 30 paisa is a fair comparison. But comparing 1 rupee with 90 paisa is unfair. Right? Because here the EPS is comparatively very much lower because of the 60 lakh equity shares. Who is this Mr. Singh? I think you don't read the questions properly, Mr. Singh. Is it Mr. Singh or is it Miss Singh? Please unmute 1 minute. Raise your hand. Just raise your hand. K127783. Please raise your hand. K127783. Can you please raise your hand for a minute? Okay. Let us go ahead. I hope you have copied down. Now you go for the next part of the restatement, that is with respect to right shares, and which is very very important. And trust me, in exam many questions till today have been raised on the right issue point. Many questions have been raised. So please understand the example that I'm going to write now, because once you understand this example, the right issue concept will be very much clear. Now, I gave you the major reason for restatement is one is comparison, and the second reason is no new funds are generated. And since the new funds are not generated for the company, technically it will not be possible to increase the EPS of the company, because if you're giving bonus shares or if you're giving splitting of shares or reverse splitting, technically no funds are generated. Now people might have thought, sir, in right issues, so we are collecting funds, na, sir. So where I can say that in right issue, no funds are collected, funds are being collected. I agree with you. But sir, the funds are not collected as per the fair market values. Funds are collected at a lesser value as compared to the fair values. So since you collect a lesser value, there is a bonus element which is included in rights. Means if the fair value of a share, fair value means fair market value or fair trading value in the share of the share in the market is 100 rupees. But the right issue is given at 70 rupees only. So technically, can I say 30 here? charging less as compared to the market. So when you are charging less as compared to the market means there is a bonus element. And if there is a bonus element, then restatement has to be done. Because then technically what is happening, because of issuing at a lesser price, you are issuing extra shares from your pocket. Means if issued at fair value, lesser number of shares are required. But since you are issuing at a lesser price, higher number of shares go from your pocket. So there is a bonus element. So please try and understand with this example that I'm giving. Let us consider there is a company called as X Limited. Okay. Now, X Limited has existing shares. So they are having, say, 10 shares of 100 rupees. Now, this 100 rupees is nothing but the fair value. Fair value means the value which is in the market. Trading value. The fair trading value is 100 rupees. So can I say the company will have a market capitalization of total 1000 rupees? Number of shares multiplied by the market price is called as the market capitalization, 1000 rupees. Now company is issuing right shares. Company is issuing right shares. Assume company is giving 6 right shares. And you might be aware that rights are given at a lesser price. So we are giving the rights only at 80 rupees. So sir, here comes the bonus element. 100 rupees worth of share, you are issuing only at 80 rupees. So can I say there is a 20 rupees lesser charge? So there is a bonus element now. So please understand how bonus element comes in. So can I say you will be collecting 480 from your shareholders? Correct? Now, if I say on total basis, you have now 16 shares floating in the market with a total market capitalization of 1480. Right? So therefore, the weighted average price, which we generally do with respect to shares, will be how much? 1480 divided by 16. The answer comes to 92.5. So technically, because of your rights being issued at a lesser price, the overall market price of your share will come down. And this 92.5 is called as what, this is called as your X right price. This is called as your X right price. And sir, what is X right price? Sir, X right price is the price immediately after the rights. The price immediately after the right issue. And you can clearly see that the fair values before the rights were 100 rupees and the values immediately after the right fell down to 92.5. And the only reason behind it was issuing the shares at 80 rupees. If you would have issued the shares at 100 only, then your X right price would have also been 100 only, because then the market cap would have been 1600. So 1600 divided by 16, answer would have been how much? 100 only. Right? And this fair value is also called as cum right price. So cum right price is what? Cum right price is what? Price before the rights. And X right price means what? Price after the rights. So always remember, X right prices will be lesser than the cum right price under any circumstance. The reason is the rights are always issued at a price less than the fair value. No company can issue its right share at a price higher than the fair value, because then who will buy it from the company? Because in market, if the share is for 100 rupees and if the company wants to invest for 105, who will buy it from the company? I would say, I will buy it directly from the market only at 100 rupees. Right? So always remember, the right price will be lesser than the market price. And that is the reason why after the rights come in, the market prices fall down. And these are called as your ex-right prices. Right? Now comes the bonus element. Now please understand. Can I say earlier, before the rights? Right? Everybody please focus for a minute. Then you copy, please focus. Let us take this. Sir, before rights, one share was equal to 100 rupees. Correct? Now, is your one share equal to 100 rupees after rights? No. So, to collect the same 100 rupees from the market, is issuing one share sufficient, or you have to issue more than one share? So, technically more than one share. Right? You are only telling me you have to issue more than one share. Now, sir, that more than one share, na, that will, the decimal which will come, that is the bonus element. That is the bonus element. So in simple terms, I can calculate the bonus element. In simple terms, I can calculate the bonus element as cum price upon X price. Cum price upon X price. That is 100 divided by 92.5. 100 divided by 92.5. It is 1.08. 1.08. And sir, please understand, this 0.08 is your bonus element, which is included in this rights. Means because of these right issues now, your market prices have come down. Why? Because you issued the right price, you issued the right shares at a lower value. So technically, before the rights, to collect 100 rupees, one share was enough. But now to collect the same 100 rupees, 1.08 share goes from your pocket. Right? 1.08 share. So that 0.08 extra now goes off from your pocket. That is the bonus element. And since there is a bonus element, restatement of EPS has to be done. I hope you're understanding this complete example. Right? Everything is in front of you. Because the rights are issued at only 80 rupees, the overall market capitalization falls. When the overall market cap falls, the overall market price per share will also come down. This is called as X-right price. Always remember, X-right price will be lesser than the cum-right price. Cum-right price is nothing but prices before the rights, which is also called as the fair value. Correct? So how to calculate the bonus element? It is nothing but fair value divided by X-right price. Fair value divided by X-right price. So you get some answer in decimal, 1 point. You will get always some answer like 1.05, 1.07, 1.12. So after the decimal, whatever it comes, that is the bonus element. Right? So see what paragraph I have written. In a right issue, there is a bonus element as the shares are issued below the fair value. So the EPS of all the periods prior to the right have to be adjusted with the bonus element. The bonus element is also called as right factor. So, sir, restating the EPS with respect to right shares, the entire question will be based on two formulas. And, sir, we have solved both the formulas here itself. The first formula was to calculate the X-right price. The first formula is to calculate the X-right price, and second formula is to calculate the bonus element. Now, how did I calculate the X-right price? Sir, it is nothing but the weighted average price. Weighted average price means fair value of the shares before rights plus proceeds from rights divided by, that is 1480 is the total value, divided by total number of equity shares after rights. You get the X-right price. And how to calculate the bonus element? Sir, it is nothing but fair value or cum-right price divided by X-right price. You get the bonus element. So you can see I have separately written the formula also over here. You can please focus on the pointer on your screen. theoretical ex-right price is equal to fair value of the shares prior to right. So in our example, fair value was 1,000 rupees. So 1,000 plus proceeds from right. How much we collected from the rights? 480 rupees. So 1,000 plus 480. 1480 becomes numerator divided by total number of shares after rights. So what are the total number of shares after rights? 16, 16. So 1480 divided by 16, you will get the X right price at 92.5. Correct? And then the bonus element. What is bonus element formula? Term right price divided by X right price. Term right price is also called as what? Fair value of share. So fair value divided by X right price. Right? So please copy this down. Meanwhile, if anybody wants to ask any queries, they can raise hands unless others are copying. Until others are copying, sorry. Finally, Mr. Singh. Yes.
Yes, actually there was network fluctuations, so I was not getting it.
So it is missing. I'm sorry.
Yes, sir. Actually, there was
Actually,
network
Beta,
fluctuations, sir.
Okay. Not an
So
issue.
I was unable to
Beta,
get it.
Okay. So
And I was
my
not having the hard copy also. So I just asked.
okay. Then
I came
let it look.
outside, sir.
Because
So
I was about to give you one suggestion that you please read the question once carefully. Now, since you are
yes,
not
sir.
having the material with you, then
Yes, sir.
my opinion will be wrong. No problem.
Yes, actually I was outside, sir. So it was getting network fluctuations. So I was getting in and getting out like that from the meeting.
Okay. Right. No
Yes.
issues.
Sorry, sir. Thank you, sir.
Yeah. Yes, Bharat.
Sir, is that fair value is the profit from existing shares? Sir, am I audible?
Hello. Yes, sir. Bharat. Yes, sir.
Sir,
You
is
are
that
asking something.
yes, is that fair value as the proceeds from existing shares?
Yes. Fair value is nothing but fair value per share, and then you multiply it with the total number of shares. So that is called as fair value of the total shares which are existing.
So in this case, fair value is 1,000.
Fair value is 1,000. Yes. Fair value is 1,000 of all these shares, but per share it is 100 rupees.
Okay, sir.
X-right price is called as theoretical X-right price. It's the name of it, theoretical X-right price, because it is derived by a formula. So we name it as theoretical X-right, but in real life we call it only X-right price. Right? And this is the bonus element, that is fair value divided by X-right price. Right? Now, the biggest point that is to be noted in this, that is, if you have read this, so the EPS of all the periods prior to rights have to be adjusted with the bonus element. Sir, please understand this point. Please understand this point. Technically, when the right shares come into the market, automatically the bonus element also comes in. Because as soon as the right shares come in the market, X-right prices fall down. Right? The prices fall down. So technically, the bonus element is arrived when the rights come in the market. Right? So when I'm saying that we have to do a restatement means we have to adjust the bonus element for all the periods prior to the right. So technically in the current year also, restatement will be done with respect to calculation of meals. Sir, if the rights are issued on 1st August, that is from 1st August to 31st March, the rights are there. So technically from 1st August, the bonus element comes in. But can I say in the current year, April, May, June, July, 4 months, the bonus element is not present. Right? So when you are calculating the EPS of the current year, for these 4 months also, you will consider the bonus factor for EPS calculation. Right? In the current year also. But for all the previous years, anyhow, you have to adjust the bonus element for restatement of EPS. Right? In the current year also, it has to be considered. That is the important point which students forget in exam. Student knows that last year I have to restate by considering the bonus element. But in the current year also, for whatever time period, 3 months, 4 months, 5 months, bonus element was not present, I have to adjust the bonus element there also. So you will understand this when I solve questions. I'll be solving 3 back-to-back questions based on right shares. So I want people to please focus. Some parts you can copy directly with me, but where I will say hold for a minute, don't copy. At that time, you please focus on the solution only. Have you written all these points? Is it completed? Okay. Now let us go for the questions. We'll be starting with question number 3. What it says, given below is the information regarding the capital of a company. 40 lakh equity shares at rupees 3.5 each. Total value is rupees 1 crore 40 lakh. Now, sir, this 3.5 rupees is nothing but fair value per share. So the total fair value of all the shares is 1 crore 40 lakh rupees. 9 months later, the company had issued 1 share for 4 share held, given rights to existing shareholder at only 2.8 per share. Now please understand, 9 months later means technically the right shares are available only for 3 months of this year. Yes or no? Right? So if technically it is April to March, So we can conclude that rights are issued on 1st January. 9 months later means January, February, March. For 3 months, right shares are available. So technically in January, February, March, when the right shares come into the market, the bonus element is automatically adjusted. Right? So no need to use the bonus element over there. So technically for the first 9 months, is the bonus element present? No. So you have to make it present by multiplying it with the right factor. Means the total number of shares will be multiplied by the right factor, so that for this 9 months period also, bonus element comes into the picture. Right? What they are saying, find out the bonus element. Now bonus element is nothing but the right factor in the right issue and also calculate variance. Right? So we have to calculate the right factor as well as we have to work out the variance for them. Right? So we can start solving the question because initial part is purely formula based. So we can note down the formulas together. Right? So we'll start with question number 3. Okay. Fair value of 40 lakh shares at rupees 3.5 each. So it is already given in the question 1 crore 40 lakhs. Correct? Then number of right shares. Can I say the question says right is in the ratio of 1:4? That is 1 share for every 4 held. So how will I calculate the right number of shares? So 40 lakhs into 1/4. So we will be having 10 lakh shares. Correct? Right? So now we'll calculate, therefore, the theoretical X right price. Theoretical X right price. So can I say fair value of the share prior to right is 1 crore 40 lakh plus proceeds from right. Sir, 10 lakh shares are issued under rights at 2.80 per share. Am I correct? The whole divided by total number of shares after rights. So we have existing 40 lakh shares plus right shares 10 lakh. So total will be 50 lakh. So it is 168 divided by 50. Sir, the X right price is 3.36. Correct? So next formula. Therefore, right factor is equal to fair value per share divided by theoretical X right price. So fair value is 3.50 divided by X right price is 3.36. So 3.5 divided by 3.36. 1.04. 1.04 is your right factor. right? Now let us go ahead. Now, sir, we have calculated the right factor. Now they say that you have to work out weights. Now I want everybody to please keep your pens down and just focus for the next 1 minute. Sir, how will the weights be calculated now? Please focus. Now, can I say before the rights, I had total 40 lakh shares? I hope everybody agree with this. Does these 40 lakh shares include the bonus element or not? Do they have the bonus element in them or no? Sir, no, they don't have. Right? So technically, we have to include the bonus element in this also for the period during which right was not there. So this I have to multiply by 1.04. So when I multiply 40 lakhs by 1.04, I get 41 lakh 60,000 shares. Right? So 1 lakh 60,000 shares are increasing. Correct? And these 1 lakh 60,000 shares are increasing because of the bonus element. Means I can simply conclude that, sir, earlier to collect 1 crore 40 lakh shares, sorry, I'm really sorry, to collect 1 crore 40 lakh rupees at a fair value of 3.5, 40 lakh shares were issued. Correct? But now, can I say the fair value has reduced to 3.36? That is, your ex-right price is only 3.36. So technically, to collect the same 1 crore 40 lakhs at a price of 3.36, you have to issue 41 lakh 60,000 shares. Right? You can check it on your calculators also. 1 crore 40 lakhs divided by 3.36. You get some answer as 41 lakh 66,667. That is because of rounding off, because it was 1.04 something. But technically, somewhere it is close to 41 lakh 60,000 shares only. Right? So that is why bonus element is adjusted. So here we are adjusting the bonus element for 40 lakh into 1.04. But this bonus element is available for a period of only 9/12. Because anyhow, after the rights come into picture, the bonus element gets automatically adjusted because the prices have fallen down after the rights. So for the period after rights, bonus element need not be adjusted because bonus element is already present in that period. So plus, now after rights, can I say we have total 50 lakh shares? After rights, we have total 50 lakh shares. That is nothing but 40 plus 10. And these are available for a period of 3/12. That is for the last 3 months. So please check 41 lakh 60,000 into 9/12 M plus and 50 lakhs into 3/12 M plus MRC. Total is 43 lakh 70,000 shares. I hope people have understood this point. So thumb rule, right factor is to be adjusted for the period prior to right. And in this question, rights was done after 9 months. So technically, for the last 3 months of the year, right shares were present. But for the initial 9 months of the year, rights were not present. So in those 9 months, we have adjusted the right factor. So 40 lakh shares we had initially multiplied by 1.04 right factor, and they are available for a period of 9/12. Because for the last 3 months, the total 50 lakh shares that we have, that is existing 40 lakh plus 10 lakh right, are already considered after the bonus element. So again, no need to multiply them by 1.04. That is the bonus element. So now you can please note this down. Start with question 4. Net profit for the year 2016 is 11 lakhs and net profit for the year 2017 is 15 lakhs. Correct? Now, please understand 2016, 2017 given means it's a calendar year, not a financial year. So it is Jan to December. Number of shares outstanding prior to rights, 5 lakh shares. So before rights, we have 5 lakh shares. And please understand, before rights, whatever 5 lakh shares we have, they don't include the bonus element. So you have to adjust them with the bonus element. Correct? Right issue price was only 15 rupees. Last date to exercise the right is 1st March. Means technically from 1st March and onwards, your right shares will be available. And can I say when the right shares are available, the bonus element era starts, right? So before 1st March, that is in the current year 2017, January and February are the 2 months period where bonus is not there. So you have to adjust the right factor for these 2 months, right? Plus, when you restate the EPS of 2016, that is last year EPS also has to be restated. Because in 2016 also bonus element was not there. So for 2016 for full year, that is into 12 by 12, the bonus element will be adjusted. Because you have to restate the EPS of 2016 also. Correct? Then further, right issue is 1 new share for each 5 shares outstanding. So 1:5 is the ratio, 1 share for every 5 held. So they've already calculated for us 1 lakh right shares will be given. Fair value of 1 equity share immediately prior to exercise of right on 1st March 2017 was 21 rupees. So technically this is your come right price. Come right price is 21 rupees. And we have to calculate the ex right price as well as the right factor. And they tell us to compute the basic EPS. Now please understand, when they tell us to compute the basic EPS, so we have to work out the EPS for 16, EPS for 2017. Now one student in the morning batch asked me, sir, why are you calculating the restated EPS? Because it is not asked in the question. Sir, my answer to that was, if there is a right issue going on, as per AS 20, it is compulsory to restate the EPS. Because I said restatement is done in 4 situations: bonus, splitting, consolidation, rights. So even if the question is silent and any of these 4 situations arise in the question, you compulsorily have to restate the EPS of previous years. So if you tell that it is not asked in question, so I will not do it, they might deduct your marks. Right? So we will first start with 2016. We will compute the basic EPS of 2016. Then we go for 2017, work out the basic EPS for 2017, and finally go for restatement of 2016. So 3 steps we have to do in this question. So let us start. Question number 4, we'll start with 2016. Net profit is given at 11 lakhs, correct? And number of equity shares is given at 5 lakhs. So therefore, the basic EPS will be net profit divided by 5 lakh. So sir, the basic EPS comes to 2.20. This was very simple. Now we start with 2017. Correct? How much is the net profit given for 2017? It is 15 lakhs. Correct? Fair value is equal to rupees 21. Right price is equal to rupees 15. Correct? And we'll also write number of right shares, which is already calculated in the question for us. 1 lakh. So let us first calculate, therefore, the theoretical X right price. Theoretical X right price. So I would say we have 5 lakh existing shares and the fair value is 21 plus the proceeds of right 1 lakh shares. We are going to collect 15 rupees. The whole divided by total number of equity shares, that is 5 lakh plus 1 lakh, that is 6 lakh. So this will come to 5 lakh into 21 M plus 1 lakh into 15 M plus MRC divided by 6 lakh. It's coming to 20 rupees. The theoretical X right price comes to 20 rupees. Right. Next is right factor, or you can call it as the bonus element. Right factor is equal to fair value divided by theoretical X right price. So 21 divided by 20, it is exactly 1.05. So technically that 0.05 is the bonus element. Means in very simple terms, I will say, earlier to collect the X amount, 1 share was issued. But now to collect the same X amount, 1.05 shares are issued. So that 0.05 that goes extra from your pocket is the bonus element. And that has to be adjusted in the prior periods. That is for the periods before the rights. Right? So now we have the right factor with us. So let us now calculate the vains first. Because for EPS, we will be requiring the vains. I want everybody to please focus for a minute. Don't copy, please focus. Let us do vains to, let me complete the vains part first. Now, can I say before the rights, I had 5 lakh equity shares before rights. And sir, in this 5 lakh shares, bonus element is not included. Right? So I have to include the bonus element now. So I have to multiply this with 1.05. And this will be only for a period of 2 months because only in January and February bonus element was not there. So I have to adjust this only for a period of 2 months. Right? Because from 1st March onwards, right shares come into the market and all my shares are adjusted with the bonus element automatically because of the fall in prices. So now I will say after the rights, I have 5 lakh plus 1 lakh right shares, total 6 lakh shares for a period of 10 upon 12 months. Correct? So let us see how much is the vains. 525 into 2 divided by 12. So these are 87,500 shares plus 600 divided by 12 into 10. These are 5 lakh shares, weighted average. So technically we have 5,87,500 weighted average number of shares. 587,500. Now you can please take a note of this. Now I can calculate, therefore basic EPS will be, sir, profit for 2017 is 15 lakhs divided by 5,87,500 shares. So 15 lakh divided by 587,500. 2.55. rupees 2.55 is the basic EPS. So we completed the second part of the question. A simple statement, since there is a right issue in 2017, the EPS of 2016 has to be restated by considering the bonus element, that is right factor. Sorry. Therefore, restated EPS of 2016 will be equal to, so the profit remains same at 11 lakh only, no change in profit, but the only change will be with the denominator, that is number of shares. So 5 lakh shares, last year we had 5 lakh shares, this will be multiplied by the bonus factor 1.05, and sir, for the last year full it was outstanding for 12 months, so 12 by 12. So this comes to rupees 2.10. 2.10. Copied everybody? Sir, how 2 months in? Sir, I think you don't read the questions properly. It's clearly written that from 1st of March, right shares are issued. So technically only January and February are the 2 months where rights are not available. No? Yes, Harsh.
Sir. Hello, sir. Am I audible?
Yes, you are.
Sir, I did not understand the last part of restating the EPS by multiplying with the right factor, sir. Like, why
Sir,
should we
my
multiply
simple-
it with 1.05? That I did not understand.
Sir, my simple question, is the bonus element included in 2016?
No, sir.
No, correct? So will that be a fair comparison? Because in 2017 bonus element is there.
Yes, sir.
2016 bonus element is not there.
Yes, sir.
So will there be a fair comparison?
No, sir.
No. So that is the only reason why we are also showing the bonus element in 2016. Sir, it is same like what we did in bonus, sir. First part.
Sir,
First
and
example for today.
yes, sir. That I understood, sir. And the reason why we are not including the right shares is we received the money for that. So we are not making any changes relating to that in the last year.
We will just adjust the right factor. That is the bonus element. Only the bonus part.
Because that no money was received on behalf of that. So we are adjusting that.
Yes. Means technically I cannot say no money is received. Lesser money is received.
Yes,
so
yes.
because of lesser money is received, bonus element pops out.
Okay, okay, sir. Understood.
Right?
Yes, sir. Thank you.
Copied everybody? So let us go for the next question, which is again very much similar type to this question only. So that is for just for the practice sake we are doing. We'll be doing question number 9. What is it stating? The following information is available for AB Limited for the accounting year 12-13 and 13-14. Now, sir, clearly they have given us the financial years 12-13 and 13-14. So it is April to March. You have to be careful with these dates in exam. Just don't blindly read the question and conclude. You have to read the dates properly, because a wrong judgment with respect to calendar year or financial year can land up in a wrong calculation of veins, because months will be completely wrong then. Net profit for 12-13 is 22 lakhs and net profit for 13-14 is 30 lakh rupees. Number of shares outstanding prior to right issue are 10 lakh shares. So these are the existing equity shares before rights. And can I say existing equity shares before rights do not have the bonus element, because they are traded at the fair values only. So since they are traded at fair values, no bonus element. Bonus element comes after right because their market prices fall down. So a share which was fetching 100 rupees now is fetching only 92.5. So technically the shares are issued at a lesser price, means bonus element comes in after the rights are coming into the market. Right issue. One new share for each 5 shares outstanding. So 1:5 is the ratio. 1 share for every 5. So 10 lakh divided by 5, 2 lakh right shares, which is also calculated in the question. 2 lakh right shares are given. Right price is 25 rupees and the last date to exercise the right is 31st of July 2013. Now, can I say 31st July is the last date to exercise right? Means from 1st August, rights will come into picture. Right shares will come in market. So can I say for the current year, that is 13-14, April, May, June, July, 4 months period is what we have to adjust the right factor in current year, right? And for last year, we have to restate for the full year only. So last year is not a problem. In last year, we have to take it anyhow for full year. But in current year, you have to consider only 4 months, because April, May, June, July, 4 months, bonus element was not present. Fair value of one equity share immediately prior to the exercise of right is 32 rupees. So 32 rupees is the fair value and you are offering the share only at 25 rupees. So technically at a very lesser price. You are required to compute. Basic EPS per share for 12-13. Restated basic EPS for the year 12-13 for right issues. And basic EPS for the year 13-14. So you have to calculate the basic EPS for both the years. Plus you also have to calculate the restated EPS for 12-13. That is because of the rights. Right. So similar type of question as compared to the last one. Let us start solving. First, we'll solve the 12-13 part. Question number 9. 2012-13. Net profit attributable is 22 lakh. Right. Number of equity shares 10 lakh. Correct. So therefore, basic EPS is equal to 22 lakh divided by 10 lakh. That is 2.20. Correct. Now we go for the next year, 13-14. Net profit given is 30 lakhs, correct? Number of right shares Given in the question, 2 lakhs. Fair value 32 and right price is 25. Correct? So therefore, first I'll calculate the theoretical X right price, that is equal to, so we had total 10 lakh shares prior to rights at a fair value of 32. So 10 lakh into 32 plus proceeds of rights, 2 lakh right shares issued at 25 rupees divided by 10 lakh plus 2 lakh, that is 12 lakh shares. The final answer comes to, this is 3 crore 20 lakhs plus second bracket value is 50 lakhs divided by 12 lakhs shares. So this comes to 30.83. 30.83. The X right price. Basically, 2 decimals will be more than fine. Don't take 4 or 5 decimals. Unnecessary, it will like create issues. 2 decimals are fine, more than enough. Now the next formula, therefore right factor and say fair value divided by theoretical X right price. So my fair value was 32 rupees divided by X right price was 30.83. So 32 divided by 30.83, I get 1.037. So I will consider this as 1.04. So what next now? We'll calculate the gains. I would say, sir, I had 10 lakh shares before rights on which there is no bonus element. So I have to adjust the bonus element on this. So multiplied by 1.04. And sir, technically these are available only for a period of 4/12. That is up to July. Because from August, all these 10 lakh shares will be auto adjusted with the bonus element. So that is why I'm considering this first for the 4 months. Then I'll say, sir, after the rights now have total 12 lakh shares on which the bonus element is already there. So no need to again adjust, and these are available for a period of 12 months. So how did I get 12 lakh? Sir, it is 1000 plus 200. 1000 plus 200 means 10 lakh plus 2 lakh. 10 lakh normal shares, 2 lakh right shares. So what is the answer for this? It's 3 lakh 46,667 plus 8 lakhs. This is 11,46,667 shares. Correct. Now you can calculate the basic EPS. Therefore, basic EPS will be, the profit is 30 lakh rupees divided by 11,46,667 shares. 30 lakh divided by 11,46,667 shares. So it is 2.62. 2.62. Right. And finally, we'll go for restated EPS for 2012-13. Now, there is no need to write the statement because question has already told us to calculate this. So no need to write the statement that we wrote in the last sum. So therefore, restated EPS will be equal to, now the last year's profit will remain the same at 22 lakh only. Profits will not change. The simple change will be what? The number of shares. So 10 lakh shares will be adjusted with the bonus element 1.04. And so technically they are available for full 12 months. So directly 12 by 12. So 12 by 12 is only for formality. That has got nothing to do with the final answer. So 2200 divided by 1040. 2.12. EPS comes to 2.12. Full solution in one stream. I'll be starting with the next concept of diluted EPS. This is something new for you people, learning for the first time. Not difficult, very simple concept. Diluted EPS, very, very simple. I think most probably in the next 1 hour or we'll be completing with this topic. Right. So before the break, we will complete certain part. After the break, we will complete certain part. Right. So I think mostly after the break, half an hour more will be required to complete the diluted EPS. Now, sir, please understand one thing. Please understand one thing. Diluted EPS is not your actual EPS. Point number one. Your actual EPS is the basic EPS. So if any person asks you, what is the EPS of the company? Your answer should be always with respect to basic EPS. So why is diluted EPS calculated? What is the reason behind calculating diluted EPS? Now, sir, what is the name diluted EPS? Now, what do you mean by the word dilute? Sir, dilute means to reduce the power of something. Means if, for example, if you put one lemon in a glass and you fill it with half water, the power of the lemon will be very high. But when you fill up the next half of the glass, Can I say the power of the lemon will come down? It will dilute. The lemon juice will dilute. Same logic applies here. So as on date, we have some equity shares. And on the basis of that equity share, I have a basic EPS. Correct? But sir, there is a probability that in the near future, some new equity shares are going to join my capital structure. So when these new equity shares will come in, technically, the EPS as compared to the current basic EPS is going to dilute. Are you getting this? So we as the management have to show to our shareholders that when in the future these new equity shares will join us, our EPS will dilute to this particular range. Means it can come down to this particular range. Right? So today we will just show a presentation of this EPS. So technically, diluted EPS is not your actual EPS. It is just the EPS presented or shown to the existing shareholders that if in the future these equity shares become actual equity shares, then your EPS will come down or EPS will dilute. Right? So what exactly do you mean by some shares coming in the future? Sir, first have a look at the definition of this, what it is given. Just a minute. What it is said, diluted EPS, DEPS, will be calculated only if there is a presence of potential equity shares in the capital structure of the company. So, sir, if there is presence of potential equity shares, now what do you mean by potential equity shares? Sir, the proper book definition is given. So I'll first go with the book definition, and then obviously I'll also explain it in a very simple term also. So what is the book definition? The book definition says, you can just focus on the pointer, a potential equity share is a financial instrument or other contract that entitles or may entitle its holder of what? The holder of a financial instrument will be entitled to get equity shares of that enterprise. Now, sir, what is a financial instrument? Sir, a financial instrument can be a financial asset for somebody and it can be a financial liability for somebody. Financial asset means you get an obligation to collect cash, or you get the obligation to collect the equity shares of a particular enterprise. And what is a financial liability? Sir, financial liability means you have to settle an obligation either by paying cash or by giving equity shares. This is the basics. So, sir, you are the holder of a financial instrument which gives you the right to get the equity shares of that company. Best example, convertible debentures, convertible preference shares. You have company share warrants, or as an employee, you have the employee stock options, right? So these are certain examples of potential equity shares. So, sir, if in your capital structure, you have potential equity share. Potential equity share means what? Sir, having such financial instruments in our enterprise, which gives the holder a right to get equity share. Means those financial instruments has a potential to become equity share in the near future. Say after 1 year, 2 year, 5 year, 10 year, as the case may be. So if in your capital structure you have convertible debenture, means you have potential equity shares, because convertible debenture has the potential to become what? Equity shares, right? If you have convertible preference shares, so technically convertible preference shares has the potential to become equity shares. If you have issued share warrants to somebody, those warrants can be converted into future into equity shares. If you have given option plans to your employees, so the employees will get the rights to get the equity share of your company in the future. So if all these people become equity shareholders in the future, can I say the number of equity shares will increase? And if the number of equity shares will increase, can I say your EPS can dilute in the future? Right? So you show them today only how much it can dilute as per today's earnings. So if as per today's earnings, my basic EPS is 3 rupees, definitely my diluted EPS will be less than 3 rupees. So technically diluted EPS is only a presentation, firstly, and secondly, it will be calculated only if potential shares are present in your capital structure. And what are potential shares? Sir, there are only 4 or 5 potential shares. First is convertible debentures, second is convertible preference shares, third is share options, fourth is share warrants, and sir, one more we have, as you can see in the example, that is the fifth one that we call as contingently issuable shares. Now, sir, what do you mean by contingently issuable shares? Sir, these are called as contingently issuable shares because the shares will be issued only upon the fulfillment of certain conditions. So there will be certain conditions attached. If these conditions are satisfied, then only the shares will be issued. If conditions are not satisfied, then it will not be issued. For example, shares issued for purchasing any company, shares issued under scheme of amalgamation, shares issued for acquisition of assets, or shares issued for settlement of a liability. So technically, these are the conditions. Condition means what? Sir, if the liability is ready to settle with equity share, then only shares will be issued. If the seller of the asset is ready to sell in exchange of equity shares, then I can say that condition is satisfied. If amalgamation works out, then only the shares will be issued to the selling company, right? So technically they are contingent. Why contingent? Because shares may or may not be issued. That completely depends upon what? Certain conditions. So these are the 5 examples of potential equity shares. And trust me, this entire paragraph can come in exam for a 5 marks theoretical question. This entire paragraph means they can ask you a question, define potential equity shares and give some examples of potential equity shares. So you will write down this entire paragraph as it is. That is definition plus A, B, C, D, E. Correct? Any doubts or queries with this part up till here? Then we will go for the calculation part. Are you getting the logic behind why diluted EPS is calculated? Right? So can I bifurcate that basic EPS is the actual EPS and diluted EPS is just a presentation shown to the shareholders that because of the potential equity shares, your EPS may dilute. Correct? Okay. Shall we move ahead for the calculation? Anybody wants to raise any query? They can. I'll wait for 10-20 seconds. If no queries are raised, I will move ahead. Yes, Mr. Bharat.
Sir, is the diluted equity share means if some convertible
EPS.
sorry,
Diluted
sorry.
equity share में diluted EPS होता है.
Diluted
Yes,
EPS
please.
means that some convertible debentures or convertible preference share may be converted into EPS in future, so that your EPS will reduce.
Converted into equity. What you speak?
EPS, sir, EPS. Is so that your share will be EPS will be reduced.
Yes,
Okay.
that is what I explained.
Okay.
You are
sir,
again
okay.
telling me my own explanation.
I
Sir,
understood
what is the
that
doubt
point.
in this? Achha. Okay.
I'm just
So you are
confirming
excited.
it.
You got it understood. So you are confirming it. Okay, I can
Yes,
see your
sir, yes.
excitement level. And it is Sunday afternoon also. After having heavy lunch, you are sitting for a theoretical class. You're a vegetarian, sir, or a non-vegetarian? I'll unmute you again. Mr. Bharat, vegetarian or non-vegetarian, sir?
Vegetarian, sir.
Vegetarian. Okay. You're from Chennai?
Yes, sir, yes, sir.
Okay. So a whistle should be whistle podu. No or yes? Okay. Very few words of Tamil I know, because some words of Tamil and Telugu are same. Some words, not all. I'm Telugu, so I know Telugu very well. Anybody from Hyderabad branch? Anybody? Raise hand if from Hyderabad branch. Anybody? Nobody. Achha, evening batch no Hyderabad students are there, it seems. Only morning batch they attend, right? Okay. Fine. So let us go ahead for the calculations now. Yes, Aditya.
Yes, sir. I just had a doubt. Is there any particular limit in the future till when the equity share, I mean, it should be converted into equity share? No limit.
No, sir.
Okay.
No time limit, because for simple example, I'll tell, if a debenture is issued for 15 years, and technically it is going to be converted into equity after 15 years.
Okay.
So the year in which you have issued the debentures, now from that year till the end of 15th year, you have to continuously work out the potential equity share. You have to work out the diluted equity.
DEPS. Okay.
Right? And finally, when it gets converted into actual equity shares at the end of the, or I would say the beginning of the 16th year, from that year, no need to calculate diluted EPS, unless you don't have any other potential shares.
Okay, sir. Understood. Thank you.
Right?
Yes, sir.
Okay. Now, let's go for the formula. The formula is, sir, exactly same. No changes. Very small change. What is the diluted EPS formula? It says net profit available for the equity shareholders after adjusting incomes or expenses with respect to potential shares. So you have to adjust some incomes or expenses with respect to these potential shares with the available net profit, and it will be divided by same weighted average number of equity shares by also considering the potential shares. Means for the potential shares also, the methodology for calculating gains will remain the same, that is time factor. Right? Generally, in examination questions, the potential shares are available for the full 12 months only. So no point arises for doing weighted average, because anyhow 12 by 12 gets cancelled. But sir, one googly question had come in exam way back, I think in 2016. One googly question had come. Now please understand, a potential equity share arises when a financial instrument comes in your enterprise. Means technically potential equity share comes in when convertible debentures or convertible preference share or share options or share warrants or contingently issuable shares come in your enterprise. Now, please understand, if the debentures are issued in the current year on 1st August, so technically the debentures will be outstanding from 1st August to 31st March. Correct? And in the current year, if I am saying that in the current year, financial year 2021, debentures are issued on 1st August 2020. So in the current year, from August to March, 8 months interest will be paid to debentures. Right? And can I say in the current year, debentures are outstanding only for 8 months? So sir, for how many months the potential equity shares with respect to debentures will be outstanding? Full year or 8 months? Full year or 8? Just a minute. Mr. Raj, please unmute.
Sir, 8 months?
It will be 8 months only, because please understand, the day when debentures came in your capital structure, on the same day, potential equity shares take birth. Right? Because potential equity share means what? Those financial instruments which have the potential to become equity share in the future.
Potential is getting converted. Yes,
right?
sir.
So please understand, this was a googly that had come. They said that debentures are outstanding for a period of 9 months. So while calculating the gains for DEPS, potential equity share will also be considered as outstanding for 9 months only. And many students made a mistake. They considered potential shares are outstanding for full 12 months and landed up giving a wrong solution in exam. Right? So please make a thumb rule. For whatever period your debenture or convertible preference shares or options or warrants are outstanding, the potential shares are outstanding also for the same month. because I can simply say convertible debenture is equal to potential shares. So whatever is the weighted average period for debenture, same will be the weighted average period for its potential shares. Right? And I'll repeat this point again if anybody has a confusion. Potential shares are not the actual equity shares. Huh? Potential equity shares are the convertible debentures only, which can get converted into equity in the future. That is why they are called as potential shares. Right? So Wales will be calculated same logic as the normal shares. For potential shares also same logic of Wales as you do for normal shares. Now let us understand what are the adjustments. Sir, if the question comes on convertible debentures. Now can I say if you convert debentures into equity, when you convert debentures into equity, no need to pay interest now? Will there be an interest payable liability? No, because debentures are converted into equity, means interest is no more payable. Can I say that will now become an income for you? Savings of expense is an income, yes or no? So I've added up over here. Interest on debentures will be added back to the net profit. Correct? Because interest is now no more payable, so interest should be added back to the net profit. That is point number one. But sir, you have to subtract the tax on interest on debentures. Now for this, I know your income tax is not started, so I will just like to explain to you with this small example that how tax on interest on debenture is subtracted. Now sir, can I say everybody is aware that income minus expense is profit, and on this profit tax is paid, assuming at 30%, yes or no? Everybody is aware about this. You have already taxation started. Salary, house property, these topics might be done. Right? So you are aware that income minus expense, whatever is the profit or whatever is the net income, on that you pay taxes. Correct? So if I say that income is 100 rupees and interest is 20 rupees on debentures. So 100 minus 20, 80 rupees is my profit, on which 30% tax I have to pay. Correct? So tax will be 24 rupees. So I will be having a profit after tax of 56 rupees. Agreed? Agreed? But sir, if I say that income is 100, but now interest is no more payable because debenture have been converted into equity. So can I say now my profit will be 100? Correct? So tax will be at the rate of 30% on 100. 30 rupees will be tax. So my profit after tax will be now 70. Now can I say my tax has increased? My tax has increased. The difference between these two is 6 rupees. And why my tax increased by 6 rupees, you know? Because I claimed a lesser expense. So lesser the expense, higher will be profit. And higher the profit, higher will be tax. So can I say the difference between tax is exactly 6 rupees? And sir, what is this 6 rupees, you know? 20 rupees of interest expense multiplied by 30%. So when you save an expense, you lose tax. When you save an expense, you lose tax. Because lower expense, higher profit. Higher profit, higher tax. So technically, you tell me how much did you save by converting the debentures? How much did you save? All figures are in front of you. Aditya is giving me an answer, 14 rupees. Aditya, can you please tell? I'm unmuting you.
Hello.
Yes.
Yes, sir. So 20 rupees of interest was saved, but then we paid extra tax of 6. So we saved 14 rupees.
So my net benefit over here will be 20 minus 6, 14. Am I correct? And do everybody agree this? Are everybody agreeable to this? Same thing, sir. Same thing I am doing in my formula. So in my formula, what I'm doing, I'm adding back the interest, but I'm subtracting the tax on the interest on debentures. Because if I am saving, technically, if I am saving 100 rupees interest, so on that 100 rupees, whatever is the tax rate, I have to pay to the government. So if my tax rate is 30%, so 30 rupees tax extra will go from my pocket. So the net benefit to me will be 70 rupees. Right? Shall I scroll upside? No need to copy down this. This was just for explanation. You will also learn this concept in detail when your cost of capital chapter starts in financial management in FM. You will be learning the cost of debt. So there you will be understanding why the debt is always taken after tax. So again, coming back, sir, with respect to convertible debentures, your net profit, adjusted net profit will be NP available to equity shareholder plus interest on debentures that you are saving. So that is why we are done plus minus tax on interest on debentures. So when you do these things, you will get your adjusted net profit. You call this as what? Adjusted NP. You call it as what? Adjusted NP. Correct? Is the debt point clear? So if in the question you have to calculate the diluted EPS with respect to convertible debentures, this is how you calculate adjusted net profit. Right? Now, sir, when it comes to preference shares, if a question is based on calculation of diluted EPS with respect to conversion of preference into equity, with respect to preference into equity, please understand, when I convert preference into equity, I will save two things. First, I will save the preference dividend. No more preference dividend will be payable. That is my first savings. Plus, when I pay dividend, I don't know whether you're aware or not, the company has to pay the taxes on dividend income. That is called as dividend distribution tax, DDT, dividend distribution tax. So simple logic, if a company is making a payment of 100 rupees dividend, it has to pay tax on that 100 rupees, which used to run 115O, section 115O for 15%. DDT was roughly 15%. So 100 rupees plus 15%, 115 rupees was going out from the company's pocket. So can I say now, if preference are converted into equity, the dividends and taxes will not be paid. So it's a complete savings for you. See, both the points are added. Plus preference dividend, plus dividend distribution tax on preference dividend. Both the points are same. Right? And sir, last point before the break. In case of diluted EPS for share options or share warrants, technically, company is not going to save anything, nor company will have to spend anything. So whatever is the net profit given in the question, that itself is the net profit available for shareholders. That's it. No adjustments will be done over here. No adjustments. Right? One point. Nobody asked me, sir, when the debt is getting converted into equity or preference is getting converted into equity, is restatement of EPS required? The answer is no. Why? Is it getting converted today? No, it is going to get converted in the future. Right? So technically no restatements are required. Right? Only diluted EPS calculation is to be shown with these points. Restatements will be done only in 4 cases: bonus, splitting, consolidations, and rights. That's it. Correct? So, yes, Mr. Raj.
Sir,
Raj, I think you should
in
switch
the
off your
preference
camera.
shares
You
where we are
switch
adding
off
up.
your camera and then speak. Sir, wait. You switch off your camera and then speak. Your voice lags. Yes, sir. Please speak now.
Sir, am I audible now?
Yes, clearly audible, sir.
Sir, in that adjusted net profit for preference shares, I just have a small
Correct.
clarification.
Yes.
When we add back the preference dividend, we aren't deducting the tax on that because preference dividend is already an after tax item. That is why.
No, sir. It is after tax item. Plus, you have to pay additional tax. See, dividend distribution tax
Okay,
is
okay.
apart from the normal income tax.
Paying out. Okay, okay.
Yes,
Sir. Okay,
company
fine.
technically pays two taxes. One is your direct tax, and
Two
on the
taxes.
profits what it has earned.
One.
Plus, it also has to pay tax on the dividends that they are distributing.
Okay, sir. Got it, sir. Got it, sir. Thank you, sir.
Right. Yeah, welcome. So you people can now go for your break of 30 minutes. After the break, we will continue with the questions of this topic. So we have to solve around 3 to 4 questions, and after that, we will put a full stop to the topic. Right? So we'll start in the next half an hour. Dikshit, please ask fast.
Sir, please show the diluted EPS for page I've taken the screenshot, sir, because the server has sorry.
Just a minute. Sir, I have already sent the PDF, sir. In the PDF, it is there.
But
You're
I didn't
using a
get, sir,
laptop?
because I'm using my cell phone, sir.
Acha. No, I told others to forward it to the students in the group, Telegram or WhatsApp group. Please take a screenshot. Full diluted EPS is there in this.
Yes, sir, I taken. Thank you.
Yeah. We'll see after the break. Bye-bye.
Let us start with the questions with respect to diluted EPS. So before the break, we completed the theoretical content of diluted EPS. We also saw the formula, and we also saw how to calculate the adjusted EPS. Right. So let us start with the questions now. We have to solve 3 questions. Question number 5, question number 6, and question number 7. Now, solving a question with respect to diluted EPS, where you have convertible debentures or you have convertible preference shares, the sums are very simple. Means question number 5 and question number 6 will be very simple. But calculation of diluted EPS with respect to share options and warrants, there is one small calculation which you have to understand. That is a bit tricky. If you understand that, then that is also very simple to solve. Right. So let us start with question number 5 first. What it says, net profit for the current year is rupees 1 crore. Number of equity shares outstanding is 50 lakhs. Basic EPS is already calculated at 2 rupees per share. That is 1 crore divided by 50 lakh shares. 2 rupees EPS basic is calculated. Number of 12% convertible debentures of rupees 100 each. 1 lakh. So 1 lakh is the quantity or total number of debentures, and the face value is 100 rupees. Each debenture is convertible into 10 equity share. So these debentures, if converted into equity, will be given 10 equity shares for each debenture. So can I say for 1 lakh into 10 lakh equity shares will be given? So these 10 lakh equity share become potential equity shares to me. Correct? With respect to convertible debentures. Now, can I say if there are 1 lakh debentures and 100 rupees is face value, the total face value of the debentures will be 1 crore. 1 lakh into 100 is 1 crore. Right? And on 1 crore, if 12% is the rate of interest, the interest should be 12 lakh rupees for full year. And sir, in the question also, they have given us interest of 12 lakh. So why I am putting focus on this? Because debentures are outstanding for full year. So VANS, that is the weighted average shares for potential shares, will be also calculated for full year only. Right? But I was talking about some Googling exam. Googling exam, what was it, you know? They gave interest as not 12 lakhs, but as 9 lakhs. So when the interest is given as per 9 lakhs, then sir, on 1 crore, 12%, if it is 9 lakh rupees, means it is only for 9 months. And if the interest is for 9 months, means debentures are also outstanding for 9 months. Correct? And if debentures are outstanding for 9 months, so you have to consider the potential shares also for 9 months only for the purpose of weighted average. Correct? But here it is not that case. So 12 lakh is for full year. Tax relating to the interest, that is 30% of the interest, 3,60,000 is the tax that is going from our pocket because of the savings in expenditure. So if you consider the net savings is 8,40,000. Compute diluted EPS. Now to compute diluted EPS, I have to do two calculations. First, I have to calculate what are the potential number of shares. And second, adjusted net profit. Once I get these two things, I can directly put it in the formula and get my EPS value. Right? So let us start with the solution. Question number 5. Correct? Now, potential equity shares with respect to 12% convertible debt will be equal to 1 lakh 8 to 10. So total 10 lakh shares. Correct? NP available for equity shareholder is given in the question at 1 CR, that is 1 crore. Right? And existing equity shares are given at 50 lakhs. This is the basic information which is given in the question that I'm filling it once again. So now first we'll calculate the adjusted net profit for calculation of diluted EPS. So first I'll write NP available for equity shareholders, that is equal to 1 crore. Right? In this, I will add up interest on debentures saved. Interest on debentures saved. So I have totally saved 12 lakh rupees. Correct? And I will subtract the tax on interest on debentures lost. So technically I will use tax. I will pay 3,60,000 as tax, which will be subtracted. So 1 crore 8 lakh 40,000 is the adjusted net profit. Correct? Therefore, diluted EPS will be equal to adjusted net profit divided by base. So adjusted net profit is 1 crore 8 lakh 40,000 divided by base. I will calculate here only in the denominator because it is the same. I will say I have existing 50 lakh shares and they are outstanding for full 12 months. So 12 upon 12 is just a formality. Plus I have 10 lakh potential shares and they are also outstanding for full 12 months. So 12 by 12. So it is technically 1 crore 8 lakh 40,000 divided by 10 lakh. So divided by 60 lakhs. It is 1.81. Please note it down. Done. Two more minutes. Please copy it fast. So if at all in exam they twist the question, they leave the clue in the interest on debenture. Yes. So you have to check the interest on debentures, whether it is for full year or not. That is the twist that they can do. So if the interest on debenture is calculated for 6 months, means it is implied that the debentures are outstanding only for 6 months. So technically, if debentures are for 6 months, then the potential equity shares with respect to debentures are also for 6 months. Shall we go ahead? Fine. We go for the next question number 6. This is again a simple one. This is with respect to preference shares, diluted EPS with respect to preference shares. So from the following information pertaining to A Limited, compute the basic as well as diluted EPS. Both we have to compute. Profit available for the equity shareholder is 20 lakh rupees. Equity share capital of rupees 10 each. So face value is 10, but the total value is 8 lakh. So can I say the number of equity shares will be 80,000? That is 8 lakh divided by 10. Then convertible 12% preference shares of rupees 100 each. Total value is 16 lakh. So total value 16 lakh, if divided by 100, then you will have 16,000 preference shares. Quantity, 16,000 number of preference shares. Right? Dividend distribution tax, DDT, is at 10%. So this 10% will be calculated on the amount of preference dividend. Now, can I say if the preference capital value is 16 lakhs and 12% is the dividend rate, the dividend will be 1,92,000. That is 16 lakh into 12%, 1,92,000. And on that 1,92,000, 10% will be the distribution tax. That is 19,200. So technically, you will save two things. Preference dividend also you will save, and you will also save the dividend distribution tax. Each preference share is convertible into 2 equity shares. So can I say we had calculated 16,000 preference shares into 2 equity shares, means total 32,000 equity shares are potential equity shares that we have to issue if in the future preference get converted into equity. Correct? Simple question. So first we will calculate the basic EPS. Then we will go for calculation of diluted, where first we'll work out the potential shares. Then we work out the adjusted net profit, and then we go for the diluted EPS. Same steps as we followed in the previous question. Right? So let us start. Basic EPS, BEPS, underline this. Net profit is given at rupees 20 lakhs, comma. Number of equity shares, I would say 8 lakh divided by 10. So 80,000 shares. Correct? So therefore, basic EPS will be equal to 20 lakhs divided by 80,000. That is rupees 25, basic EPS. Correct? Let's go ahead now. First, I'll calculate number of 12% preference shares. I'll show total value is 16 lakhs divided by 100 rupees face value. So you have 16,000 shares. Correct? So therefore, potential shares with respect to 12% convertible preference shares. And in the question, it is clearly given we will be issuing them 2 equity shares. So 16,000 multiplied by 2. So 32,000 shares are potential. And can I say the preference shares will be outstanding for full 12 months because no specific information is given. So it is simple that preference shares are outstanding for full 12 months. So technically the potential shares will be also considered for full 12 months for the purpose of weighted average. Correct. So now I'll calculate adjusted net profit. Adjusted net profit for calculation of DEPS, diluted EPS. So first I'll say LP available for equity shareholders is given in the question at 20 lakhs plus preference dividend saved. In the bracket I'm showing up the calculation, it is 16 lakhs into 12%. So that is 1,92,000. Plus 10% dividend distribution tax saved on preference dividend. So preference dividend is 1,92,000 into 10%. That will be 19,200. So this comes to 22 lakhs something. $22 lakh 11,200. This is your adjusted net profit. I'll finally go for diluted EPS. So therefore, diluted EPS is equal to adjusted net profit divided by Vains. Adjusted net profit calculated at 22,11,200 divided by, can I say I have 80,000 existing shares outstanding for a period of full 12 months, right? Plus 32,000 potential shares, and these are also outstanding for the full 12 months. Divided by 112,000. 19.74. Correct? 19.74 is the diluted EPS. Please complete this. Done? Okay. Now we go for the last question of this topic, that is question number 7. Now, I want everybody to please focus on this question for time being, because the calculation is something different. If anybody is still pending to copy, please do it. I'll wait for 1 or 2 minutes more, because I can see some people still copying. We'll go for question number 7. Now, please focus why this question solving is a bit different as compared to what we did for conversion of debt or conversion of preference. And this is a question with respect to options. Net profit for the year 2017 is rupees 12 lakhs. So we put the rupees symbol over here. And weighted average number of equity shares outstanding during the year 2017. So they have already calculated the weights at 5 lakh shares. So we will not do again 12 by 12, not required, because they have already calculated. They say average fair value of one equity share during the year 2017 is 20 rupees. Average fair value means almost throughout the year, the shares were traded roughly at around average 20 rupees. So fair value is given to us. Weighted average number of shares under options. So we have given options to our employees, means they will have the option to get equity shares of the company in the future. So total 1 lakh shares are given under option, and these are already weighted average shares. So 12 by 12, everything is done. Exercise price for shares under option during the year 2017 is 15 rupees. Means the employees are not going to get these shares for free. They are going to pay us. But how much are they going to pay us? Sir, only 15 rupees per share. Means 5 rupees less than the fair market value. Right? They are telling us to calculate the basic and the diluted EPS. Now, sir, why are you saying that it is something important? Please understand. In the previous question, that is conversion of preference to equity or conversion of debt to equity, can I say at the time of conversion, no new funds got generated? Apart from that savings and all, keep the savings apart, that what you did in adjusted profit. Is any capital generated? So technically no. So that is the reason why entire shares were taken as potential. Means in the first case, I think some 10 lakh shares were taken as potential. In the second case, entire 32,000 shares were taken as potential. Correct? But here, can I say company is generating 15 lakh rupees in the form of capital? Yes or no? That is 1 lakh shares multiplied by 15 means company will collect 15 lakh rupees from the employees. Correct? So, can I take all the 1 lakh shares as potential? Because capital is generated. And sir, please understand, when capital gets generated, so can I say that capital will be again invested in the business? And when you invest that capital in the business, it will have some returns, increase the returns, right? So will it dilute your EPS or it will not dilute your EPS? Means will it reduce your EPS or it will not reduce? It may increase your EPS also. it may increase, sir, because capital is generated. Please understand this. Capital is generated means technically the capital will be invested. And if capital is invested, you are going to earn returns on it. So your EPS may not come down. Rather, I would say your EPS may increase, right? So on technical grounds, I can say that these all 1 lakh shares are not dilutive because they are generating capital for the company. So, sir, why are we calculating diluted EPS? Sir, with only one reason we are calculating diluted EPS, that is, you have issued the shares at lesser price. Means there is 5 rupees bonus element again. 20 worth of share is given at 15. Right? So here again there is a bonus element. Right? So whatever is the bonus element, only those number of shares will be considered as diluted. Whatever is the bonus element, only those number of shares will be considered as dilutive. Please try and understand this working that I'm showing. Right? This is rough working. Don't copy this. Now, can I say company is going to collect 1 lakh into 15 rupees. Can I say company is going to collect 15 lakhs? Is everybody agreeing? Now, technically, give me one answer. If I have to collect the same amount of 15 lakhs from the shares if issued at fair value, if I issue the shares at fair value 20 rupees, how many shares are required? 75,000. Right? So if share issued at fair value, so I will say to collect this 15 lakh rupees from the market at 20 rupees, sir, only 75,000 shares would be enough. Correct? At fair value, only 75,000 shares should be more than sufficient. How many did you issue? 1 lakh. So can I say, because of the reduction in price, you landed up issuing 25,000 extra shares? Correct? Only those 25 are dilutive. Only those 25,000 shares will dilute your EPS. Because on technical grounds, I'll say that only on technical grounds, or not on reality basis. Only on technical grounds, I'll say that 75,000 shares, full value is collected. 25,000 shares are given actually at free of cost. Right? You gave total 1 lakh shares. But sir, to collect the same funds, only 75,000 shares are more than enough. Correct? So if 75,000 are more than enough, you issued 1 lakh means for 75,000 shares, full value is collected and the balance 25,000 are actually given at free of cost. On technical grounds, I'm saying no shares are given at free. For every share, 15 rupees is collected. Right? But because the value has been reduced, 20 fair value, and you are giving at 15, because you are giving at a 5 rupees lesser value, you had to give up 25,000 extra number of shares. And these extra shares are going to dilute your EPS. Right? I hope you are understanding this point. So this is the only tough calculation that student has to understand. Rest, there is no problem in this question at all. So please understand, whenever under options or warrants, share options and share warrants, both treatments are same. Because warrants are also given at a discounted price. Discounted as in prices will be lesser than the fair market value. So because of that lesser price, technically there is bonus element, and because of the bonus element, you land up giving more shares. So whatever extra shares you have given, that is only called as the diluted, that is only called as the potential shares. Right? So how will we start the solution? I think we should first start with the basic EPS part, because that is asked in the question. So this is question number 7. First, we'll go for basic EPS. What is the data given? 12 lakh profit, 5 lakh number of shares. So net profit is equal to rupees 12 lakhs Bains is already calculated in the question. 5 lakh equity shares. So therefore, basic EPS will be equal to 12 lakh divided by 5 lakh, 2 rupees 40 paise. Correct. Now we'll go for diluted EPS. Now there are two ways of calculating this 25,000. I'll show you both the methods. One is formula based and one is complete proper step by step. Both the points I'll show you. Now, number of shares under options. 1 lakh. Option price given in the question 15. Fair value given in the question 20. Correct? No. Next line. Number of shares to be issued if at fair value. Means if you are issuing the shares at fair value, then how many shares you have to issue? That is what we will calculate first. So I would say, sir, on 1 lakh shares, we collected 15 rupees. So 15 lakh is our collection. So to collect these 15 lakhs on the fair value of 20 rupees, only 75,000 shares are more than sufficient. Correct? So please focus for a minute, stop writing. Therefore, potential shares with respect to options will be equal to number of shares issued under options minus number of shares if issued at fair value, which is equal to 1 lakh minus 75,000. So, sir, technically these 25,000s are dilutive. They have a dilutive effect on your EPS. Balance 75,000 don't have a dilutive effect because for them you have collected capital, which you will invest in your business. So they cannot dilute your EPS. So this is the one way of doing this, where it is done in a proper step manner. Or you can also do it with applying a simple formula or potential. Please check the formula. Potential shares is equal to number of shares divided by fair value multiplied by difference of fair value and option price. This is the formula. So that is equal to number of shares are 1 lakh divided by fair value is 20 multiplied by difference is 20 minus 15, 5 rupees is difference. So you get 25,000 shares. So these are the two options available to you for calculating. So choice would be completely yours. You can go for the formula also. Sorry. Let's go ahead. Right. Therefore, diluted EPS will be NP available, because here we don't have any adjusted net profit, because whatever is the net profit is same as the adjusted also. So NP available for equity shareholders divided by Bains. So the profit is given at 12 lakh rupees. So that will remain the same. Divided by existing, we have, I think, 5 lakh shares. Yes. Plus potential are 25,000. $2.29. Diluted EPS 2.29 per share. Please note down. Yes, Mr. Adarsh.
Yeah, sir. Like I'm actually a morning batch student, sir. Yeah, because like I had to attend some webinar relating to investment, something like Varun Maitra. So I missed that second half session in morning. So I came to this second half session in the evening, sir. Can
No
I ask
issues,
that?
sir. No
Yeah,
problem, sir.
Like with respect to that fifth one question, sir. Yeah, as you said, if the debentures were
Please go on.
Yeah, sir. Yeah, with respect to fifth one question, sir. Fifth question. Yeah, if the debentures were issued for 6 months, if the debentures were issued for 8 months, sir, if 8 months, if debentures converts after to equity shares after 8 months, so we should take the equity shares for only 4 months, no, sir?
Sir, you are getting this completely wrong. Sir, the equity shares are not going to get converted in the 8 months over here. The debentures were outstanding for 8 months during the current year.
Yeah, yes, sir. So after 8 months, it will be converted to equity shares.
No, sir. After 8 months, who said it is going to get converted? We said that if the debentures are issued in the current year, in the month of August.
Yeah.
So from September to March, it will be there in the balance sheet.
Okay, yes, sir.
Right? They are not going to get converted right now. Now, please understand, if in the current year they are going to get converted into equity share, then why will I calculate, why will I consider them as potential? They will become actual equity share in the current year.
Yeah, yes, sir.
Right? Our question was, in the current year, if the debentures are outstanding for 8 months, because they might have been issued, say for 9 months, say they are issued on 1st July.
Yeah.
So if the debentures are issued on 1st July, so 1st July to 31st March, for 9 months, they will be there in my balance sheet.
Yes, sir.
Right? So the potential equity shares will also be there for 9 months only. When the debentures come in my capital structure, I can say that potential equity share also comes.
Oh,
so if the debentures are outstanding for 9 months, then the potential shares are also for 9 months only.
Okay, sir. And
see, you have to understand this simple point that convertible debenture is equal to potential shares, because see, what are potential shares? Potential shares are not actual equity shares.
Yeah, like
they are nothing but your financial instruments have the right to get converted. Means your convertible debentures have the right to get converted into equity share. That right makes them potential equity shares. Means they have the potential to become equity share in the future.
Okay, yes, sir.
So technically, when convertible debentures come in your capital structure, I can say that on the same day, potential equity shares take birth.
Yeah, yes, sir. Yeah.
Because your convertible debentures are equal to your potential shares.
Okay, sir. Like, so if those potential debenture, if those potential shares gets converted, it gets converted on like say November. So in that period, only that now till the November only we should consider.
Yes. Till October only you will consider them for calculation of diluted EPS, because then they become actual shares.
Okay.
From up to October, they will be considered as potential, but from November, they become what? Actual equity shares. So they will be considered under actual shares when you are calculating diluted EPS. And up to October, they will be considered under potential.
Okay, like we should apply the time factor wala thing, no,
Sir, I'll tell you one thing. You are actually going in a very advanced way, because such advanced questions are not asked in your inter-level ethics.
Okay, sir.
So don't get confused, because you have many things. In final, you will learn all these things. These complications come in final level, and we will be learning this in the relevant Indias. That what shall be done. So complications and all, keep it for there, because you have many other complications also to handle. So my suggestion would be stick to the basics. Whatever is there, basic level, you learn this.
Okay, sir. Okay.
Right? Whatever you are saying is absolutely correct. I have a solution for it, but the point is, other students will be like, what is happening?
Yes, sir. Okay.
Right? And even you will be getting confused in somewhere. So that is why I don't want to increase any of your confusion levels.
Okay.
So let us stick to the basics. Right? Because such advanced questions don't come. Like in the current year, the debentures are getting converted into equity. So how will the potential shares be diluted EPS be calculated? Now, one more point I'll just add up to conclude this. Sir, if the debentures are converted into equity, correct? And in the same year, you don't have any other potential shares. You had only convertible debentures, they got converted into actual equity shares. Apart from this, you don't have any other potential shares, then diluted EPS will not be calculated only. You getting this? Diluted EPS will be calculated only if you have any other further potential shares in your capital structure. But when the potential shares get converted into actual equity shares, in that year, if you don't have any other potentials, your diluted EPS will not be calculated only. I hope you understand this. So here we conclude the chapter AS 20